A bank assesses home loan basics. This week, I got to talking to Christine. She's an assessor at one of the big 4 banks, and her role is to look through home loan applications. She's the one that has the rubber stamp to say, yes, you're good, or no, your dreams are crushed. So I asked her, what are the basics? What do you actually look for when you're assessing a home loan application? And her answer, you're gonna be pretty surprised. So in this video, I'm gonna take you through Christine, a real life Australian bank assessor's home loan basics and her tips to getting your home loan approved. And if you like this video, and as a thank you for Christine, make sure you give us a little thumbs up. So like I mentioned, Christine and I got to talking. And she is a credit assessor inside one of Australia's big 4 banks. And while you'd like to think there's lots of algorithms and flashing lights and mainframes that are saying yes and no to your loan application, the reality is, in most cases, your home loan application goes to an individual human, an assessor, that will look through your bank statements, your pay slips, and make a decision as to whether or not you're gonna get your home loan approved. So the first question I asked, and you're probably wondering, is how much can I borrow? Christine's rule of thumb is 6 times your income. Now, this is going to depend on if you've got lots of personal loans, help debt, car loans, that sort of stuff. But it's a general rule of thumb. And she did mention they'll look at up to 8 times your income in special circumstances. Which got me thinking, do banks actually care about how many assets you've got? Interestingly, with Christine's bank, assets don't count to their credit grading system. So in other words, you can have tens of thousands of dollars in crypto, but it's not going to help get your loan approved more. What they're more interested in is your income and your serviceability. So it got me wondering, what does serviceability mean? You might have seen it thrown around, you might even see on the bank's website, so they'll use servicing calculator, but what are they doing? Serviceability is another way of saying eligibility, or how much the bank will lend you based on your income. The way they do this is they look at your income minus any living expenses times a sensitized loan repayment. So in other words, they'll look at the loan you're looking at borrowing, maybe 300,000, and instead of using today's interest rates at 2, 3, 4%, they're gonna look at it and base it on a 6 or 7% buffer. And don't forget, they're gonna do a similar thing to any other liabilities you've got. So if you've got a car loan, some banks will slap on a 20% buffer. In Christine's case, she said that they slap on a 30% buffer on your car loan repayments to work out your borrowing capacity. So keep that in mind. If you've got any old credit cards, personal loans that you don't need, car loans, or even zip pay, start to close them down because they could be reducing your serviceability or how much the bank will lend you based on your income minus your liabilities. Now, Christine said one thing that does trip up a lot of first home buyers when she's assessing their applications is HECS debt or help. With HECS, it's assessed on your gross income. So if you're earning $100,000 and you only owe $1,000 left on your HECS debt, the bank will take off $7,000 a year in your annual repayment. So make sure you check out the HECS or the help tables and even your MyGov website to see how much is owing. Because if it's affecting your borrowing capacity and you only owe $1,000, but it's reducing your borrowing capacity by $100,000, it's an easy decision to make. Actually, just check. It's 9.5% on 100,000. We'll leave a link below for the help or HECS table. So one that does come up a lot, and I had to ask Christine about, was credit files and the importance of a credit score when she's assessing a home loan application. So I had to ask. We deal with lots of first home buyers at Hunter Galloway, and lots of them don't have credit cards or any credit facilities at all. So it doesn't matter that they don't have an established credit history. She just laughed at me over the phone, just said, Jayden, everyone starts with a generic score in Australia, and unless you've got any defaults, missed your payments, or any bad history, the bank's completely fine if you've got no credit history in the past. They're more concerned about serviceability and the other items we mentioned. Christine did walk me through some of the recent changes on credit files, and in particular with Equifax, which now holds your last 2 years repayment data. It's called comprehensive credit reporting. So with her bank, they don't even ask for your statements for your credit cards, your personal loans, your car loans. They don't ask for your statements anymore. They literally rely on your credit report. So you need to be careful because your credit report shows your last 24 months of repayments. And she said she had someone that she had to decline 2 weeks ago because they had missed repayments on a card they had closed 18 months before. They'd missed repayments 3 times in a row, 3 months in a row, and it was enough for their bank to say, no, it doesn't meet our credit policy conduct. So more than ever, it's critical to stay across your credit file, get a copy of it and understand what's on there. Another common mistake Christine sees with credit files is forgetting, or some people just outright lie and don't disclose credit cards. She said the most common one is a Latitude or a GE credit card, where you might have forgotten about it and genuinely not remember it, but you can't lie to the bank because they see it. It's on your credit file. Your credit file now has not only your repayment data, but any open credit facilities. And she says, in her bank's case, if you've just forgotten about it, they're not too bad. But if there's 4 or 5 missing that you just didn't disclose in your application, it's a straight out no, and the bank will decline your loan. Now, what about living expenses? This is one that Christine said has come up more and more since the Royal Commission. Previously, the banks would put $1 in there and they weren't too concerned. But Christine says she has to actually go through your day-to-day statements and make sure your living expenses that you're actually spending match up with what you've declared on the application. So in a lot of cases, she said that she'll see $2,000 declared for living expenses, and most people don't even know what they're spending. So I'd definitely heed this warning. Have a look at your statements, use a budgeting app like Pocket App, and try and have a look at what you're spending. If you're a single person, for example, the banks measure you against HEMS, and your living expenses on there are around $1,900 to $2,000 a month. So check out what you're spending. If you're way over that, then maybe look at where you can cut back to make sure you don't end up on Christine's naughty list. Now, interestingly, Christine did also mention that the banks will go off either the greater of your declared living expense or their HEM, the measure that they use to compare what you should be spending per month based on Australia in general. So just keep that in mind, because if you declare you're spending $6,000 a month, it could affect your serviceability and derail your home loan application. Christine started giving me the wrap up, but I thought I had to ask her one last question, especially around income. There's a lot of people out there that have novated leases, deductions, car allowances, all sorts of fun stuff on your payslip. So I was wondering how Christine actually treated this when she assessed a home loan application. The answer kind of surprised me. If you work for the government, maybe the hospitals, you might be getting paid on top of the minimum super. And I said, well, Christine, can you add this back? Can it be stopped? And she said, no, because it's not voluntary. So the first thing Christine sees on payslips all the time are super contributions. And she told me that there's two types, it's either voluntary or non-voluntary. Involuntary, it's where I might want to make extra contributions to my super and I'm putting in there 30 or 40% towards that. Because that can be stopped at any time, they can use that income. I can tell my employer to stop that. Christine said she's happy to use that income towards increasing your borrowing capacity on the application. If it's non-voluntary, your employer chooses to make extra contributions to your super and you can't stop them. That means that the bank cannot use that income towards your application and cannot use that to increase the amount they'll lend you. So there's a lot to know when you're doing a home loan application. If you're not sure, chat to a mortgage broker. At Hunter Galloway, we help home buyers across Australia and we would love to help out with your home loan. If you'd like any more info, hit us up below at huntergalloway.com.au, and until next time, see you later.